Well, greetings. It's Kevin Rudd here from New York. I join you as President and CEO of the Asia Society. My friend and colleague and fellow trustee of the Asia Society, Mark Tucker, also, of course, Chairman of HSBC, has asked me to speak to you about two or three things. One, the role of the Chinese economy in the global economy for the decade ahead. Number two, the risk, possibility or probability of some form of decoupling between China, the United States, and possibly the broader West. And three, what that might look like. So let me spend a few minutes on each in the 10 minutes I've been asked to speak with you today. On the first, which is China's future role in the global economy, we're all familiar with the findings of the economic historians, and that is that if you look at the rise of China as an economic power, if and when it becomes the largest economy in the world, sometime in the late 2020s, possibly the 2030s, it'll be the first time since George III was on the throne of England that a non-English speaking, non-democratic country and economy, and non-Western economy, will be the largest in the world. And that therefore carries with it profound implications for the future of the rules-based system. Of course, China now is the world's second largest economy. When we look at GDP as measured by market exchange rates, it's already the largest trading country in the world, the largest exporting country in the world, the largest source of foreign direct investment, and the largest manufacturing country in the world. There is something extraordinary about the sheer scale of the economy, which generates these numbers, both as a domestic market, but historically as a source of extraordinary manufacturing and export to the rest of the world. So the question mark for the future is, can China continue to sustain this? And what are the risk factors which get in the road of that? I'd like to simply list a few of those. Number one, of course, is demography. In economics, demography is destiny, also in politics. And the truth is the size of the Chinese workforce has been shrinking since about 2015. There is an open debate about whether the size of the Chinese population itself has begun to contract, or that its peak population point will be between now and, say, 2027. And thirdly, on top of that again, what this means in terms of the size of and demography of the Chinese workforce and the population more broadly, and the ability of the country to continue to sustain its living standards in the future, given that the age dependency ratio will now rapidly increase. Add to that a social phenomenon, which is that women aren't marrying as much. And as a consequence, despite the relaxation of the one-child policy to become a two-child policy and to become the as many kids as you'd like policy, frankly, it's not yet been reflected in the data in new births. Second structural headwind is as follows, and that is the question of whether current economic policy settings on the part of Xi Jinping's China are helping or hindering China's overall growth. Here the question is one of ideology and the extent to which Xi Jinping has pushed the centre of gravity in Chinese economic policy decision-making too far to the left over the last 5 years. We see that with the tech platforms, we see that with the rehabilitation of state-owned enterprises, we see that also with the emerging common prosperity agenda about income redistribution for the country and corporations at large. My concern has long been that this has been tunnelling through to a view on the part of the Chinese private sector that they are not as welcome in the future as they have been over the last 35 years, and China's extraordinary record of economic growth and development. And as a consequence, therefore, that we begin to see a decline in the rate of growth of Chinese private fixed capital investment, a huge driver of China's growth in the past. And remember, the Chinese private sector, as of recently, represented 61% of Chinese GDP and the bulk, the vast bulk of innovation within the Chinese economy. That's headwind number two. Headwind number 3, of course, is the ups and downs of the pandemic. This, of course, is more of a seasonal factor than necessarily a long-term structural factor, or at least that's what we all hope. But China's zero COVID tolerance policy, of course, is now confronted with the reality that COVID has jumped the border from Hong Kong into the Chinese mainland. And while China sustains its policies, which I believe it will, of zero COVID through to the end of this year, through to the end of the 20th Party Congress due in November, the bottom line is lockdowns of major cities like Shanghai, like Shenzhen, like Changchun, and like others are going to rapidly impact China's existing growth trajectory. You begin to wrap these factors together, we come to one last one, which of course is the impact of geopolitics. And the impact of what has happened with Ukraine and the Russian invasion, obviously its impact on geopolitical risk, its impact on global prices for energy, possibly on the prices for other commodities as well, then ultimately filters through into global growth and therefore the continued demand for Chinese exports, and of course, China's own capacity to sustain inflationary pressures domestically. Wrap all that together, and we therefore have serious headwinds. We all know that China's growth numbers have slowly been coming down, projected to be 5.5% in calendar year 22. But those of us who follow the entrails of the Chinese economy believe there's no way on earth that that number can be realized in practice unless there is a significant degree of government stimulus. And if you have a significant degree of government stimulus delivered by the central government, by provincial governments and by local authorities and through the state-owned enterprise sector, guess what? A lot of that's going to be debt fueled. And as a consequence, you continue therefore to create a factor which acts as a continued systemic financial risk underpinning the long-term stability of the Chinese economy. One footnote to all the above is the property sector. Property, real estate, and residential construction are big factors in China's overall growth picture. And if you look carefully at what's been happening with the Chinese crackdown on financial speculation within the property sector, and of course, the demographic factors beginning to weigh down on residential construction. And given that residential construction represents 15% of GDP, and given that the property sector at large represents some 25 to 28% of GDP, a non-healthy Chinese property sector and housing sector within it also creates a further set of headwinds. Bottom line, looking for the decade ahead, absent further intensifying geopolitical risk, question marks are being raised about the actual sustainability of Chinese growth numbers beyond trend growth of, say, 3% for the decade ahead. Chinese numbers, 5.5, real numbers, potentially sub 5 or even less. Still healthy, but for a country which is still a developing country and still not yet through the middle income trap, for the first time perhaps for all these reasons, a question mark about the very long-term growth prospects for the Chinese economy. The final questions I was asked was about the probability, risk, possibility of decoupling and what it actually might mean in practice. In the United States, there is a debate within the Congress and elsewhere and within the administration about the extent to which financial and economic decoupling between the US and China should occur. The truth is, some level of decoupling is occurring, but it is uneven. It's best to consider this in a number of different analytical boxes. If you looked at trade, for example, notwithstanding the US-China trade war, under the extraordinary policies pursued by Donald Trump, the bottom line is that the overall dynamics of US-China trade haven't been radically affected. China's bilateral trade surplus with the United States, for example, continues to improve rather than to deteriorate. But it's quite true that in certain traded categories, most particularly in sensitive categories, like microprocessors, computer chips, semiconductors, that a new range of restrictions is being considered and will therefore result in one level of decoupling or another. When it comes to foreign direct investment or foreign portfolio investment behaviour, then of course changes are already occurring. New restrictions have emerged in terms of FDI flows, more inbound into the United States rather than outbound into China. On portfolio investments, while there are not at this stage significant restrictions in terms of inbound investment from China that I have seen, portfolio investments, of course, into China may come under increasing levels of scrutiny in the United States. And then, of course, there's the question of equities markets and what will happen in the future of listings on the New York Stock Exchange and elsewhere. Technology I've partly touched upon, namely what happens with the future of both artificial intelligence and, of course, the engine room of all of the above, the future of semiconductors. The new US so-called CHIPS Act, a $50 billion US protection package for the US industry, together with other restrictions on Chinese technologies, not simply 5G and Huawei, point to a bleak picture indeed on the nature of decoupling within technology more generally. And finally, perhaps more disturbingly, a decoupling in terms of talent. The level of scrutiny now on Chinese nationals for immigration, for student visas, and for working in Silicon Valley is huge. And of course, there will be similar sensitivities heading in the reverse direction, although the flow of talent into China is much less than the flow of talent into the United States from China historically. So certain elements of decoupling are unfolding, including, of course, in the macro question of supply chain security as it affects both China and the United States. But the error in the analysis is to conclude that decoupling will simply be a discretionary decision by the United States. The impression I get looking at the Chinese official literature on these subjects is that Xi Jinping and those around him have concluded that the United States, since around about the middle of 2019, has begun to embark upon a general strategy of decoupling anyway. Xi Jinping's new national self-sufficiency strategy is designed to offset that by reducing the impact in China and by pursuing, therefore, an industrial policy within its self-sufficiency policy, which enables China to rapidly advance in terms of self-sufficiency in critical technology and other areas. Of course, in the critical area, again, of semiconductors, according to industry experts, China remains some 3 to 7 years behind the United States in terms of critical microprocessor categories and subcategories. But the gap over time may well be closing. But my overall point on this is that the pace of decoupling will be determined largely by decisions not just taken in the United States by the government, but also by the Chinese themselves as they seek to make themselves more resilient against the threat or the risk of future trade embargoes or financial sanctions against China itself, particularly in long-term scenarios associated with Taiwan. Of course, the final element in the overall decoupling phenomenon are corporations themselves, making decisions in anticipation of government decisions both in Washington and Beijing. So in summary, question marks about China's long-term growth trajectory, but still remember, as you all do, and know full well as active market participants yourselves and investors and traders, that the unrealized potential of the Chinese consumer remains very large indeed. It simply will depend on consumers, like businesses in China, sustaining their levels of confidence that they had in the past as they look to the future. And on decoupling, ultimately, politics does triumph over economics, and the politics of decoupling is unfolding. But the traded sector of the economy and the technology sectors of the economy's decoupling is easier to execute than the decoupling of capital markets. That's where it gets really complex indeed. And if there were to be comprehensive decoupling at that level, then we may be looking at forms of mutually assured financial and economic destruction. Back to you, Mark, and I'm pleased to have been with you and your colleagues in London today.